Hello and welcome. Thank you for joining us for our latest investment insight and client update. I'm delighted to be joined once again by Dean Cheeseman, Managing Director of Client Investment Solutions at Mattioli Woods. Dean, thank you for taking the time to share your views with us today.
Thank you for inviting me back.
Before we begin, a quick reminder, this video is recorded on 23rd September 2025 and all views are current as of today's date. Please also bear in mind that this is not intended to provide any financial advice. For specific guidance relevant to your situation, please contact your usual Cullen Wealth financial planner. Dean, let's start with the United States. The US stock market continues to hit new highs and remains very dominant. Do you see this strength continuing, or are there risks that investors should be aware of?
Sure. And the US has been dominating markets and commentary for quite a little while now. So what we've observed is US growth companies in particular, AI themed, have led the way. The US economy more broadly has led the developed market. So we've had the strongest economy, and within that we've had some of the fastest and largest growing businesses. In terms of how we've positioned at Mattioli Woods, back in the summer, back in June, we just at the very margin moderated the US exposure, but we're cognizant that again we're seeing continued strength both at the corporate and the economic level relative to the rest of the world, but we're wanting to just broaden away from these very large US tech AI themed businesses and get into the broader economy. So we've had a theme of broadening out, but the risks are that these growth stocks continue. And we could have taken a similar position many quarters ago and been caught out. So we're edging slightly. So when we talk about an underweight this time, it's very much at the margin.
Thank you. Alongside that, what impact are you seeing or expecting from President Trump's policies and plans on both the US economy and markets more broadly?
So Trump brings a completely different dynamic, and ordinarily politics shouldn't influence markets, not to the degree that we've observed in the very recent past since Trump came in. Now the most impactful, there have been a number, but the most impactful policy move that Trump has made that has certainly impacted markets in the way that they've moved has been tariffs. And tariffs were made broad brush back on Liberation Day, and it was a sweeping application. Since then, we've seen Trump moderate some of those tariffs for certain countries, and then he's also increased for others. Now, what we've observed from the market is initially concern, uncertainty. Markets don't like uncertainty. So in an environment of a changing dynamic, we saw an incredible amount of volatility. But the markets have now gone, there's a lot of noise. The evidence, and by evidence I mean, what are the corporates who are trading in this tariff environment feeding back? And it seems to be that the corporates are largely absorbing the impact of tariffs so far. So they've got two choices. They either wear the impact of the higher cost, the impact of these tariffs, or they try and pass it on to the consumer. And so far in the main, they seem to be wearing it themselves. Now this then comes back to the first challenge that we talked about just very briefly on the US and stretch valuations, because the market is expecting a certain amount of earnings in order to maintain these higher level of valuations, but in an environment where corporates are struggling maybe to weather and absorb these increased costs themselves without passing into the system becoming inflationary, then are those earnings expectations too high? So we're walking a tightrope. Politics shouldn't be playing such an influence, but we are where we are. And I guess more recently, what have we seen with Trump? It's interference with the Fed. He's trying to get his way. He'd love to see interest rate cuts. Now, Chairman Powell is holding firm, independent, but already we're seeing the personnel change and they're a little more empathetic towards the Trump policies coming onto that Fed board. So political influence is very much ripe. And again, that potentially has more uncertainty for markets. Uncertainty typically means volatility.
Thank you, Dean. I want to move on now to just talk about our lower risk investors. You know, that they've not had the experience over the last 3 to 5 years than they had hoped for. Inflation has been high and is remaining stubbornly high. Interest rates have been very volatile but are now reducing. Many of our lower risk investors have seen their portfolios stabilise and recover somewhat since the cost of living crisis, though some ground is still to be made up. How do you see the outlook for our low to low medium risk investors in this environment?
So typically a low risk portfolio and a portfolio for a lower risk client would have a higher proportion towards fixed interest. And fixed interest is particularly sensitive, as you say, to inflation rates and interest rates, which the central banks will moderate or adjust interest rates in order to try and control inflation. Now, we've seen inflation come down from sort of the recent highs, but you're referencing here this above the 2% long-term goal that many of the developed central banks set out their stall to. And it's this last mile, it's this last sticky bit of inflation. So all the central banks in developed markets are now trying to walk a very fine line between cutting rates to stimulate economic growth as we are late cycle, and they're trying to prolong the growth in the economy, versus this sticky inflation, which ordinarily you're increasing interest rates in order to try and take the heat out of. The good news for low risk investors is the absolute level of yield, the income you get from gilts, UK government debt, is attractive. So the starting point of the low risk portfolio is at an attractive level, and then when you build out into other fixed interest instruments across that risk spectrum, into corporate credit and high yield, where we're monitoring closely is the additional income that you receive for buying corporate over government. There's a spread, and you expect a premium, this spread, in order to compensate you for the additional level of risk for buying a corporate over a government. The government is considered to be much, much lower risk. Now, relative to their own history, these spreads, this premium is much tighter, and that's an amber warning. But if I look on the other side, as we're talking about the central banks and governments are trying to prolong this economic cycle, and at the moment, they're doing a good job. And in an environment where the economy is largely robust, we don't see an environment where corporate defaults are likely to increase. So corporate debt, those companies are likely to continue to be able to service their debt. And in that environment, government's an attractive initial level of income. Corporates able to service the debt, there's a premium on top of that. Again, being able to service that level of debt. It's okay, but we have to keep an eye on the rates at which governments are able to continue to issue debt and the knock-on spread for investors that they receive as they move into higher risk fixed income. But at the moment, they're set fair.
And in a declining interest rate environment where inflation remains, as you describe, sticky, the risk, of course, is that your investments and savings don't keep pace with the cost of living and decline in real value. So where you've got that decline in cash rates and higher inflation, possibly for a little longer, the risk, of course, of holding surplus cash means that you're actually going backwards and it's potentially costing you.
And with that, exactly, so you don't want to erode into the buying power. So you leaving cash, as you say, as a large component of the portfolio is not necessarily an advisable policy. Yeah.
Thank you. I just want to look with you about the UK economy, Dean, if I may. How does it compare, would you say, with other major markets right now? Are our government's policies supporting growth or holding it back? So if you look at the broadsheets, there's a lot of negativity generally around government policy at the moment. We're about 12 months in to what is a very strong Labour government in terms of seats in the House, and they're putting policies through. They didn't inherit the economy in a great state. But when we look at the UK as an investment position, there's a difference between the economy and the market. And the market tends to look through the phases of an economy to the medium term, as I say, where politics should have less of a short-term influence. So when we look today, we actually went overweight the UK. That was the corresponding trade to the underweight to US that I mentioned a little earlier. And we went overweight the UK because we believe the valuations, the underlying value of the businesses that make up the UK market were underappreciated. And our reference points to this were twofold. First, we observe a very high amount of directors buying their own shares. Now, if a director's buying its own shares, that ordinarily indicates, because they know far more about the running of that business over a short, medium, long term than the market,
that things are really cheap. So when you're seeing broad spread direct to buying, that's a really positive buy signal. And that was supported by overseas investors, many of them US, buying UK companies and taking them private. And again, that suggests to us on an international basis, UK PLC is cheap. So that drove us to go overweight. And what are the policies coming through from government? Look, we've seen NI go up, we've seen wage growth go up. That in certain industries has maybe stymied some reinvestment coming through, but elsewhere, UK PLC continues to deliver. We've got attractive levels of income. We're not seeing a deterioration in the economic fundamentals. We think we're reasonably set fair.
Thank you. Next item on the list is our views on environmental and social governance investing, ESG as we describe it. Many people are at this stage unsure about the prospects with ESG, with Trump's drill baby drill. So it's faced some challenges recently. Do you think it still has a meaningful place in portfolios today, and how should investors approach that?
Yeah. ESG investing has come under the spotlight, again politically led, again Trump led. We remain strong proponents. We're cognizant, obviously, that there are frustrations the other side of the pond, where Trump has reintroduced fossil fuel as part of the US energy mix. I think it's fair to say that artificial intelligence is very much here to stay, and there needs to be a recalibration. And, sorry, I'm talking about just a very small proponent here of ESG, and it's focusing in on renewable energy, but it's what's capturing a lot of the headlines at the moment. But in order to service these AI businesses, these data centers, which are incredibly energy hungry, we're going to have to come up with a different energy mix. So ESG's got two roles to play. Our primary role is that of a risk tool, is an additional risk function. So the UK still has ESG legislation. So businesses that are on the right side of that legislation are less likely to be fined, and there's less likely to be any reputational damage. Specifically drilling into some of the renewable energy, there are challenges, and maybe some of the early renewables didn't generate energy at quite the rate that was originally anticipated, but we're seeing new technologies come through. Now, the challenge for new technologies is they're not always profitable straight off the bat. So they tend to have borrowings, and we've seen interest rates normalise. And in an environment where the cost of servicing that debt has continued to go up, and you haven't yet hit cash flow positive, and you're not necessarily a business in profit because you are still developing and growing into this new technology, it's maybe stymied some of the growth. But these are still some of the most exciting growth prospects for the medium longer term. And again, we're focusing on just one aspect of ESG, but it really highlights where the longer term growth and complement to a broader portfolio is going to come from.
Thank you. Last question. Just looking ahead more broadly, what do you see as the biggest opportunity for investors, and conversely, the biggest risk that they should be mindful of?
So the biggest risk for ESG is going to be political. And the need maybe to change our energy mix, just to loop back to the previous question, certainly transcends a lot longer than a 4 or 5 year political term. So we're very excited by the prospect of some of these new growth businesses coming through. We're cognizant of new industries needed to support that. So as we touched on just a moment ago, AI is incredibly energy hungry. The UK, we've got solar, we've got wind, we've got other versions of renewable energy, but what hasn't kept pace with these new energy technologies is the storage. And AI, data hungry, energy hungry data centers are going to be needing energy on a continuous basis. So what's been really exciting, literally in the last week or two, with Trump coming across, meeting King Charles and members of the government, are takeaways where we are going to be forming relationships around AI development. That then puts a spotlight on how we're going to fix the energy. And the talk of nuclear and small modular reactors, where the UK is actually a leading developer in the advancements of these new technologies. So I think that's why this is coming about. The US needs this technology as well. The UK is a leading developer in it. They're going to invest in the UK, help expedite that. That technology will be sold over to the US or shared with the US, but it's carbon free. it forms part of a broader energy mix, is probably far more reliable than solar. And this is where the excitement comes from. This is why ESG, looking at it more broadly, should fulfill part of an overall client portfolio.
Thank you, Dean. That's all we have time for today. Dean, thank you again for your valuable insights and perspectives. And thank you to you for watching. We're always keen to hear your thoughts and questions, so please don't hesitate to ask those via your usual Cullen Well financial planner, and we'll be pleased to help where we can. Thank you and goodbye.